couple of micro pockets. When Credit Access Grameen hit the primary market in August 2018, analysts had suggested avoiding the issue due to its geographical concentration in Karnataka and Maharashtra. But investors have lapped up the stock in the secondary market. It's in fact doubled in 2019. So what's working for the microfinancer? Has something changed? Shefali Malik is standing by to tell us that. Shefali, good morning.
Hi, good morning. First of all, to start with, it has given stellar returns ever since it's listed, about 78%. And, I went back to the IPO notes. Most of them had, including some of the most credible analysts, had actually said avoid because of the geographical concentration that it has in two states, Karnataka and Maharashtra. Ever since then, it has given 78% returns. In 2019, it was one of the best performing NBFCs. Among NBFCs, it had about 100% return. So it was a top two actually. Amongst NBFC MFIs, it was obviously the top performer. In comparison, Satin Credit Care, Ujjivan, etc. All these, most of these gave negative returns in 2019. And there's one player, Spandana Sphurti, that got listed in 2019 itself. With that, the comparison is a bit closer. Since Spandana's listing, Spandana gave 40% returns and Credit Access has given 51% returns. And the performance of the others have been mixed since then, that is August 2019. So that's about the share price performance, about what is really working for them. So basically, instead of, so one of the biggest concerns among the MFI players is the geographical concentration always, because we know already what happened to Andhra Pradesh couple of years back when there were regulatory changes, and always they're prone to risks such as natural calamities, political risks, etc., regulatory concerns. That's always there, that if the margins get capped further at any point of time. So that's always a risk. But instead of focusing on the state diversification, what the company actually did was they actually focused on districts. So they went district by district and nurtured those districts, and that's the strategy that they took. So they had declining concentration in terms of the district. So if you actually see in percentage of AUMs, the ones which contribute to less than 0.5% has been increasing from 65 to 77 now, and the ones which contribute more than 5%, those number of districts have actually come down to nil. So in that sense, the contribution is getting more and more granular from each individual district. Aside of that, if we look at the financial performance, the AUMs have grown at about 44% in FY19, and the last 5 year CAGR has been 49%, and the profit has grown by about 35% in the second half of this financial year versus about 60% over last 60% CAGR over last 4-5 financial years. And in addition to that, their margins have also been holding up. It's a given that's what the management told me, that it's around 12% and would continue to stay around that. Their gross NPAs have also come down from 0.8% at the time of Q4 FY18. I'm taking that particular quarter because after that they listed, so just as a comparable. And now at the end of the second quarter, it's 0.5%, so barely minimal, and net NPAs are almost nil. And if we look at the cost to income ratio, so instead of, even though they're going district by district, so that means that they would have more executives to look after those districts. But despite that, their cost to income ratio has been coming down. From in FY15, it was about 46%, and now it's about 39.8%. So consistently, it has been coming down because of the higher concentration on the districts. They've actually been able to retain their customers, and hence the cost to income ratio has been coming down. Now, what's been working for them? So the strategy that they actually took was that they actually nuanced their operations into many smaller processes. So they have a differentiated business model. So this is as per many analysts, the analysts who have covered the stock. I have spoken to some of them, and according to them, the biggest differentiator is the weekly meetings that they conduct, whereas most of the other MFIs and the players who are now getting into it, some of the MFIs, some of the banks, they have a model of conducting monthly meetings. So that is a big differentiator. So that helps in deeper engagement with the customers, and that helps in maintaining the asset quality as well. And they have different credit limits for each borrower within a particular group. aside of that, they provide a flexible repayment facility to most of their to all of their borrowers. So the borrowers can choose when they decide to pay weekly, fortnightly, or monthly. So that also helps, and they have a multiple product approach as well. Within the credit limit that they provide to a particular borrower, they actually offer multiple other products as well, such as festive loan, etc. And many other MFIs are really not doing that. So this is a very differentiated approach that they've taken, and once they grow in one particular district, then they go to the next adjoining district. So that's what their approach is. Other than that, so they recently acquired Madura Finance also, which has AUMs of about 2,100 crores. So that will reduce the geographical concentration, also bring down state concerns as well.
Okay, Shefali, what did the management have to say in the conversation with us earlier? What are they guiding for in the near future?
Well, yes, I did speak to the management about what are their plans. So the management thinks that the AUMs will continue to grow at about 35 to 40%, as there is huge potential in the MFI business, specifically in the rural areas. And they would continue to remain focused on rural. They don't have plans to get into other businesses such as SME, which many other MFI players are doing. And they plan to continue to add about 30 to 40 districts per annum. And remember, one of the strongest points for them is that they have an international promoter, so which has been helping them in getting international funding, and that share will go up to about 30 to 40% in 2 years versus 20% currently. And they do need to bring down the promoter shareholding as well in about 1.5% to meet the regulatory requirement. So they would be fastening the process of fundraising, and the discussions for the same would actually start in the second half of FY21.